When most individuals embark on their trading journey with an initial capital of just $100, their mindset instantly flips into full-on get-rich-quick mode. They vividly picture doubling their account in a single week, perhaps rocketing to $1,000 within a month, and soon they're fantasizing about quitting their day job to live off their gains. This very mentality is the root cause of why the vast majority fail. Turning $100 into $1 million isn't about lightning speed. It's about cultivating the profound ability to think in decades, not fleeting days. The mental framework that makes this possible is called the compounding mindset, a deep-seated conviction that slow, consistent, and strategically orchestrated growth will always triumph over fast, reckless windfalls. This mindset is anchored in unyielding patience, ironclad discipline, and a visionary outlook that transcends immediate impulses. At first, it lacks glamour or excitement. It doesn't deliver the adrenaline rush of massive bets where your account balance swings wildly like a pendulum in a storm. Yet this is precisely the same mental approach that forged colossal fortunes across every industry, from Warren Buffett in investing to Jesse Livermore in speculative trading. It's the thought pattern that compels you to safeguard your capital. Like a sacred treasure, nurture its steady expansion and never undermine your own progress. The average trader views $100 as trivial, a sum they can afford to lose without consequence. The millionaire trader, however, sees it as a seed, a latent potential. You don't devour the seed. You plant it in fertile soil, water it consistently, and shield it from harm. If you keep digging it up to check if it's sprouting faster, you doom it to failure. In trading, this translates to fiercely resisting the urge to overtrade, risk excessive portions of your capital, or dive into random setups out of sheer boredom. That $100 account demands absolute respect because how you treat small amounts is an exact mirror of how you'll handle large ones. Consider this deeply. If you can grow your account by a modest 5% per week, seemingly underwhelming in the short term, yielding just $5 profit on 100, most traders would scoff. Yet over time, the mathematics becomes staggering. At a 5% weekly compounded growth rate, $100 transforms into roughly $10,000 in under 5 years. And if you maintain that same mindset with larger capital, the numbers explode into hundreds of thousands, then millions. The principle is elegantly simple. Growth multiplied over time produces results that initially seem impossible, almost miraculous. The tragedy is that most traders fail to think this way. They'd rather risk 50% of their $100 on a single trade because a win catapults them to an instant $50 gain. What they blind themselves to is that 2 consecutive losses nearly wipe out their account and shatter their emotional equilibrium. This is where the compounding mindset irrevocably separates winners from losers. Millionaire traders never gauge success by one trade or 1 week. They measure it through a disciplined series of actions spanning months and years. Take the iconic example of Richard Dennis, the legendary commodities trader. In 1972, he started with a modest $1,600 and turned it into hundreds of millions over the next decade. He didn't achieve this through gambling or luck. He did it by applying consistent, repeatable, methodical rules to every trade and letting time do the heavy lifting. This story isn't about chance, it's about disciplined patience elevated to its zenith. This is the mindset you need, even if you're starting with less than 1% of what Dennis had. The compounding mindset also forces you to view losses through a radically different lens. Most traders panic at a loss, seeing it as an insurmountable setback. A trader steeped in this philosophy knows losses are an integral part of the game, factored into the overarching plan. If you lose 2% of your account today but stick to your strategy, you can recover it over time without resorting to excessive risk. This emotional stability is critically vital. If one bad trade drives you to impulsive revenge trading, you've already lost the mental battle. Now let's delve into emotional energy, an often overlooked dimension. Trading isn't just about cold charts. It's about your mental state when making pivotal decisions. If you're chasing quick money, you're trapped in perpetual anxiety. Every micro movement in the market feels like a life or death crisis. You can't think clearly or objectively. The compounding mindset eradicates this pressure by eliminating the urgency to get rich now. It redirects your focus to consistently making the right move day after day. This not only makes trading less stressful, but also enhances the intrinsic quality of your decisions. A common mistake among novice traders is destructive self-comparison. They see someone on social media flipping $500 into $5,000 in a week and feel inadequate, as if they're missing something essential. What they don't see is that those performers often take colossal risks, and many blow up their accounts soon after. The compounding mindset tunes out this noise. It's about forging your own path at your own pace, with rules you can adhere to unconditionally, no matter the market's whims. For instance, imagine you have $100 and aim for 3–5% weekly growth. You have a robust strategy generating 2 to 3 high-quality trades per week, each with a 1.2 risk-to-reward ratio. You risk 2% per trade, $2 on a $100 account. A win nets $4. It seems trivial, but after months of rigorous consistency, your account begins to swell. At $500, each win yields $10. At $5,000, it's $100 per win. The process remains identical, only the zeros multiply. This is the core principle that transmutes small accounts into fortunes without imploding along the way. There's a hidden, often overlooked benefit to starting small with this mindset. It compels you to master risk control before handling significant capital. Too many traders receive a sudden influx, savings or prop firm funds, and squander it in weeks because they never learned to respect small amounts. By honoring your $100, you train yourself to respect $100,000. It's the same game, just a grander scoreboard. Understand, too, that the compounding mindset isn't passive. It's not about sitting back and hoping for magical growth. It demands active refinement of your strategy, continuous learning from mistakes, and adaptation to shifting market conditions, all within a framework of controlled risk. You're not swinging for home runs, you're aiming to get on base every day. Over time, those consistent base hits accumulate into a championship season. Some traders resist this approach because it feels agonizingly slow. But ask yourself, introspectively, what's better, spending 6 months chasing quick wins, blowing up multiple accounts and ending back at zero, or investing those same 6 months building a track record of steady growth so that when larger capital arrives, you're ready? One path offers fleeting dopamine highs followed by lasting frustration. The other forges discipline, confidence, and the potential for genuine wealth. Let's be clear, the compounding mindset isn't just about money, it's about identity. When you adopt it, you begin to see yourself as a seasoned professional, not a reckless gambler. Professionals think in systems, probabilities, and long-term goals. Gamblers bet on luck, hunches, and one big score. The market rewards the former and punishes the latter mercilessly. Your $100 is your training ground to become the trader the market respects. Ultimately, the compounding mindset boils down to this: protect your capital with vigilance, grow it steadily, and never rush the process. Master this with $100, and you've laid the mental foundation to turn it into $1 million. The numbers will evolve, but the mindset remains constant. Once truly internalized, you'll realize that your small account isn't a limitation. It's your greatest asset. In trading, patience isn't merely the ability to wait. It's the ability to wait without self-destructing in the process. Most traders think they're patient because they can hold a trade an extra 5 minutes or endure a minor pullback without closing early. But ruthless patience is on another level. It's standing before the market, watching price dance mere inches from your ideal entry and still refusing to pull the trigger because the setup isn't 100% perfect. It's seeing the market tempt you with movement, volatility, and the illusion of juicy opportunities, and doing nothing because you understand that not trading is also a trade. This mindset is rare because the market is engineered to trigger impatience like a sophisticated trap. From the moment you log in, every candlestick is a pressing invitation. Every price tick whispers, act now before it's too late. If you're not ruthless with your patience, those whispers become commands and you obey. A trader without patience will fabricate trades in every fluctuation. A trader with ruthless patience acts only when the odds are overwhelmingly in their favor. We recall a trader in 2003 who imposed a strict rule, maximum 4 trades per month. Not out of laziness, but because his system only produced 4 high-probability setups in that window. 1 month, he waited 23 days without placing a single order. On day 24, his signal appeared. He entered, managed the trade with surgical precision, and earned more in that one position than most impatient traders made in an entire month combined. When interviewed, he said something that stayed with me ever since. If the market will still be here tomorrow, why rush today? That line encapsulates the essence of ruthless patience. The challenge is that patience feels like inaction, and inaction feels wrong when you're supposed to be working. Our brains equate productivity with frenetic activity. In an office, you type emails, attend meetings, make calls. In trading, the most productive act can be staring at the screen and doing absolutely nothing. This feels unnatural. Your hands itch to click. Your mind convinces you that any movement beats stillness. And so you break. You enter too early. You chase. You trade setups that are almost valid. You sabotage yourself. Ruthless patience isn't passive. It's active waiting. A conscious, deliberate choice to preserve your capital until your exact required conditions are met. This demands Herculean mental strength because the world glorifies speed, instant results, and quick wins. Trading rewards the opposite. In the market, the tortoise doesn't just beat the hare blows up its account while the tortoise compounds slowly into financial freedom. A legendary commodities trader in 1982 made hundreds of millions but traded only about 15 days a year. People assumed he had some mystical edge. In reality, his edge was pure discipline. He knew his setups so intimately that he could identify them instantly. On every other day, he simply did nothing. He described waiting as boring as watching paint dry. But when the trade came, it was like stepping in front of a moving train with perfect timing. That's ruthless patience, waiting for the train you know is coming rather than chasing every shadow. To cultivate this mindset, redefine winning. Winning isn't making money every day. Winning is following your plan every day. If your plan says trade only when specific criteria are met and nothing satisfies them, then not trading is a resounding victory. The impatient trader measures success in pips and dollars. The patient trader measures it in avoided losses and preserved mental capital. This subtle but powerful shift removes the pressure to force trades. Consider the psychological toll of impatience. Every premature entry that turns into a loss chips away at your confidence. Every unnecessary loss forces you to trade harder just to break even. And trading harder often means trading worse. This is the downward spiral that obliterates accounts. Ruthless patience stops the spiral before it begins. It's a shield against your worst instincts. Of course, ruthless patience isn't innate. It must be trained. It starts with absolute clarity. Without a clear, well-defined trading plan, you can't be patient because you don't know what you're waiting for. The mind hates uncertainty and will convince you that any opportunity is good enough. When you know exactly what a perfect setup looks like, you can reject everything else with confidence. The clearer your rules, the easier it is to filter out the noise. In 1995, a futures trader named David H. was mentored by one of Chicago's top pit traders. The mentor told him, "If you can stand on this floor all day and make 0 trades, you're ready to be a pro." David initially thought it was a joke. Why be a trader and not trade? But after blowing his account twice, he understood. The mentor wasn't teaching him to avoid trading. He was teaching him to avoid bad trading. That year, David focused on waiting. He let dozens of potential trades pass. When his exact setup appeared, he executed with precision and size. By year's end, his win rate had improved by over 40%, not because his strategy changed, but because his patience did. The true test of ruthless patience comes during drawdowns. When you're losing, the temptation to recover quickly is overwhelming. The impatient trader doubles down, chases high-risk trades, and tries to force the market to give back what it took. The patient trader accepts the drawdown, steps back, and waits for the same high-quality setups that made them profitable in the first place. This is counterintuitive, but it's why the patient trader survives and grows, while the impatient one burns out. Patience is also the foundation for scaling. Imagine your $100 account. Impatient, you might double it to $200 quickly, then crash back to $50 just as fast. Patient, you might grow it by just 5% in the first month, but that 5% compounds. Your small, steady gains build a stable base that can handle larger positions and bigger opportunities. Impatience chases explosions. Patience builds empires. One of the hardest parts of ruthless patience is handling what-if moments. You skip a trade because it doesn't meet your rules, and it ends up a winner. The impatient part of your brain screams, "See, you should have taken it." But here's the truth. A good process will sometimes let winners go. That's not a flaw. It's the price of long-term survival. Your job isn't to catch every winner. It's to take only the trades that fit your edge. The market will always offer more opportunities. Missing one doesn't matter. Breaking your rules does. Patience also affects trade management once you're in. An impatient trader cuts winners short because they can't bear the thought of price reversing. A patient trader holds to the full target because they trust their system's probabilities. Thus, patience isn't just about entry timing. It's about the entire trade life cycle. From waiting for the setup, to letting the trade play out, to waiting again for the next one, patience is the constant thread of consistency. Note that ruthless patience doesn't demand perfection. You'll still take trades you shouldn't. You'll still close early sometimes. But the goal is to make patience your default state. The more you practice it, the more natural it becomes. And over time, your account will reflect the shift. Fewer trades, higher win rates, lower stress, greater freedom. If one image captures ruthless patience, it's the lion in tall grass. The lion doesn't chase every antelope it sees. It waits, it watches, it studies the herd, and when the perfect target comes within range, it strikes with full force and precision. That's how you survive in the market, not by running after every flicker of movement, but by conserving your energy until the odds are stacked in your favor. In the end, ruthless patience isn't just a trading skill, it's a life skill. It teaches you to value quality over quantity, to trust your process, and to resist acting for the sake of action. It's not glamorous, it's not exciting. But it's why some traders quietly compound their way to financial freedom, while others burn out in a blaze of overtrading. Master this, and your $100 account may not grow overnight. But given time and patience, it will grow beyond anything you can imagine. One of the hardest lessons for traders to internalize is that the market doesn't care about your feelings, your hopes, or your desperate wish for a setup to work out. The market isn't your friend. It isn't your enemy. It's a merciless mirror that reflects the truth about how disciplined or undisciplined you are. And the harsh reality is that most traders lose because they tie their emotions too tightly to each individual trade. They treat every entry as if it must work, as if it defines their worth as a trader. But the truth is, no single trade matters. What matters is the collective outcome of hundreds of trades over time, executed with consistency, not desperation. A trader who risks $100 and loses feels the sting. But an undisciplined trader feels something far more dangerous, the urge to get it back right now. That's how revenge trading is born. You start seeing setups that aren't there. You force positions just to erase the pain. And the market punishes that every single time. You must become emotionally detached from the outcome of each trade. You must see a loss as just another step in the process, not a personal attack or a threat to your future. I've seen traders with brilliant technical skills fail because they couldn't master the emotional side. One in particular had a win rate above 60%, but his losses were twice the size of his wins because the moment a trade went against him, he panicked. He'd close early or flip the position entirely. He knew the chart was telling him to stay patient, but his emotions screamed to act. He wasn't losing to the market. He was losing to his own reactions. That's why emotional detachment isn't optional. It's a survival skill. Think of it this way. Imagine flipping a coin, knowing that over 100 flips, heads will come up about 50 times. You wouldn't panic if the first 3 were tails, because you understand probability. Trading works the same. If your strategy is profitable over time, a single loss doesn't matter. In fact, 10 losses in a row don't matter, as long as you stay disciplined and keep following your edge. But if you let emotions take over, you'll abandon that edge and suddenly you're gambling instead of trading. In 2008, during the global financial crisis, a trader I knew personally made over $400,000 in just 6 months shorting bank stocks. His strategy was rock solid, his timing impeccable. But after a sudden reversal cost him $50,000 in a single day, he lost control. He started doubling down on bad trades, chasing moves that had already happened, trying to make back what he lost. Within 3 months, all his profits were gone. He later admitted it wasn't the market that ruined him. It was his inability to emotionally accept being wrong. He wanted the market to make him feel right again. And the market doesn't do that. The mindset you need is one of detachment. This means when you place a trade, you've already accepted that you could lose that money. You're not trading to be right. You're trading to execute your plan. If the plan says cut the loss, you cut it. If the plan says hold to target, you hold. There's no room for, but maybe it'll turn around thinking. That's emotional attachment speaking, and it's the enemy of consistency. The best traders I've met treat each trade like one grain of sand on a beach. They know one grain doesn't define the beach. One win or loss is irrelevant in the big picture. They don't celebrate wildly when they win, and don't spiral into frustration when they lose. They focus on the process, not the outcome. That's the key, process over outcome. Because the moment you judge yourself based on a single result, you hand your emotions the steering wheel. Detachment also means removing ego from the equation. Your trades are not you. Losing a trade doesn't make you a bad trader any more than winning one makes you a genius. Ego will push you to prove yourself to the market. But the market doesn't care about proving points. Ego will keep you in bad trades because you don't want to admit you're wrong. But the market rewards those who can admit they're wrong quickly and move on. A humble trader who cuts losses without hesitation will always outlast a proud trader who refuses to let go. One thing I tell new traders, your job is not to predict the market. Your job is to manage risk while letting your edge play out over time. That's it. Once you grasp this, losing trades stop feeling personal. They just feel like business expenses. Imagine owning a restaurant. If you have to throw out a few meals because an order got cancelled, you wouldn't shut down the whole restaurant in frustration. You'd keep serving, knowing the overall business will be profitable as long as you work the system. Trading is the same. Losses are the cost of doing business. In 1995, a small-time trader in Chicago started with just $2,000. He traded options and barely broke even in the first year. But what set him apart was how little he cared about each individual win or loss. His entire focus was on refining his process. He treated every trade like a test of his discipline, not his intelligence. By 2001, he had turned that $2,000 into $3 million. When asked how, he said something I'll never forget. I stopped needing the market to make me feel good. I just needed it to follow the math. That's emotional detachment in its purest form. You can train this mindset. Step 1. Define your risk before every trade. If you decide you're willing to lose $50, accept that loss before you click buy or sell. That way, when it happens, it's not a shock, it's just the plan. Step 2. Focus on the next trade, not the last one. Win or lose, the last trade is dead. The only one that matters is the next one you take with discipline. Step 3. Keep your trading size small enough that losing doesn't cause emotional damage. If you're so nervous about a trade that you can't think clearly, you're risking too much. When you strip emotions out of trading, something magical happens. Your decisions become sharper. You stop chasing. You stop hesitating. You start following your rules with military precision. And the market starts rewarding that precision over time. Remember, the market is a brutal teacher, but it's also fair. If you consistently make disciplined, detached decisions, the long-term math will work in your favor. But if you let emotions take the wheel, the market will teach you the same painful lesson again and again until you either quit or learn. Emotional detachment doesn't mean you don't care about winning. It means you care more about discipline than about any single trade. It's the same mindset professional poker players use. They know sometimes they'll have a great hand and lose, and sometimes a weak hand and win. The important thing is that they play their strategy correctly every time. That's how you build a fortune from a small account. That's how you turn $100 into $1 million over time. And maybe that's the part most traders miss. This isn't about bending the market to your will. It's about bending your own mind into a shape that can survive and thrive in the chaos. Once you no longer need the market to give you emotional comfort, you're free to trade purely on logic and probability. And that freedom is where the real money is made. Markets are living, breathing beasts. They change. They evolve. They punish those who think they've figured it out and reward those who adapt without ego. The mindset of relentless adaptation is the mental edge that separates traders who survive from those who get wiped out. It's not about predicting the future perfectly. It's about adjusting when the present changes unexpectedly. The traders who stay in the game long enough to grow a small account into something life-changing understand that nothing is permanent in the market. Not trends, not volatility, not patterns. In fact, the moment you become overconfident in a method, the market often shifts to make it less effective. And here's the dangerous trap. Your brain craves familiarity. It wants you to keep doing what feels comfortable. That comfort can kill you in trading. In 2008, when the global financial crisis hit, traders relying on stable long-term positions found themselves in chaos. The ones who adapted quickly, switching to short-term trading, tightening risk control, and exiting fast, didn't just survive, they thrived. They didn't waste time blaming the market. They didn't insist it would go back to normal. They acknowledged the game had changed, and changed with it immediately. That's the mindset. Relentless adaptation means you never marry a single strategy. You treat your approach like a tool, not an identity. If the tool is no longer useful, you set it down and pick up another. Many traders fail because they confuse consistency with stubbornness. Consistency is applying sound principles over time. Stubbornness is refusing to change when conditions demand it. This mindset also requires killing your ego every single day. Ego makes you think you're smarter than the market. Ego tells you your analysis can't be wrong. Ego whispers, hold the trade a little longer. It'll turn around. Ego wants to be right more than it wants to make money. A trader with relentless adaptation doesn't care about being right, only about being profitable. Look at nature. Species survive by adapting to their environment. When the environment changes faster than they can adapt, they go extinct. Trading is no different. Your strategies, risk tolerance, and even your trading schedule must evolve with market conditions. Some months you may trade aggressively because volatility is high and opportunities abound. Other months you may trade rarely, preserving capital because setups aren't clear. You adjust without guilt, without frustration, without fear of missing out. One of the most powerful ways to develop this mindset is to treat every market condition as a teacher. When the market is trending, it teaches you momentum discipline. When it's ranging, it teaches you patience. When it's unpredictable, it teaches you risk control. The worst traders complain about bad markets. The best traders study them, adapt, and extract lessons that make them sharper for the future. The key is to make adaptation a habit, not a reaction. If you only adapt when forced, you're already behind. You should be testing new methods, timeframes, and risk models before you need them. This way, when conditions change, you're not scrambling. You're simply switching gears. It's like a fighter trained in multiple martial arts. No matter what opponent steps into the ring, they have an answer. In 1995, there was a trader named Marty Schwartz, famously known as Pitbull. He was already a legend in stock index futures trading. But when he realized the game was changing, he didn't cling to the old ways. He expanded his skill set, studied different markets, and even adjusted his risk profile. That ability to evolve kept him profitable, while others who refused to change lost everything. His success wasn't just skill, it was his refusal to stay static. Relentless adaptation also means embracing discomfort. Growth happens when you willingly step into uncertainty. If you only trade setups that feel safe, you'll limit your potential. The market will always find ways to challenge your comfort zone. Sometimes it'll change speed, sometimes direction, sometimes it'll just grind sideways for weeks. Your job is to move with it, not against it. And here's the part most traders miss. Adaptation isn't just about your technical strategy, it's about your mental state. Some days you feel sharp and focused, ready to take on the market. Other days you're tired, distracted, or emotionally charged. The adaptive trader recognizes this and adjusts position size, frequency, or even decides not to trade at all. They adapt not just to the market, but to themselves. This mindset is the final piece of the puzzle, because without it, all the discipline, patience, and resilience you've built can be destroyed by one stubborn refusal to change. The market is not obligated to reward your favorite setup forever. It's not interested in how well your strategy worked last year. It doesn't care about your opinions. It rewards those who flow with it like water, flexible but with force when needed. If you want to turn $100 into something much bigger, you must be ready to reinvent yourself as a trader again and again. Every level of growth demands a different version of you. The beginner learning to manage risk must adapt into the intermediate trader who masters emotional control. That trader must adapt again into the advanced trader who can read the market's mood almost instinctively. And even then, the adaptation never stops. There will be times when adaptation feels like starting over. That's normal. Every time you adjust, you're sharpening your survival skills. You're proving to yourself that you're not here for quick wins. You're here for the long game. The $100 trader who becomes a millionaire isn't the one who finds a perfect system. It's the one who becomes a shapeshifter in the face of change, reinventing themselves as many times as necessary to stay ahead. So burn this into your mind. The market owes you nothing. It doesn't reward hard work alone. It rewards adaptability. The trader who wins isn't the one who fought the market and won. It's the one who moved with it so skillfully that they never had to fight at all. If you've followed every chapter so far, you now have the 4 cornerstones: discipline, patience, resilience, and relentless adaptation. Master them, and your small account will no longer be limited by its size. It will be limited only by your imagination and your willingness to grow. And remember, the market is a mirror. If you're rigid, it will break you. If you're fluid, it will carry you forward. Be the trader who bends, shifts, and transforms as often as necessary. That's how you survive. That's how you thrive. That's how you turn $100 into $1 million. If you enjoyed this video and want more powerful trading psychology insights, make sure to subscribe to the channel so you don't miss the next one. Now, I want to hear from you. What's the biggest change you've had to make in your trading mindset, and how did it impact your results? Drop your answer in the comments. I read every single one.